This is the current federal tax developments for the week of August the 18th, 2025. Current federal tax developments are brought to you by your state society of CPAs. Med Zollers, and I am presenting this week again from Phoenix. Down here, not this week being able to get up to Flag. So we're down here, kind of doing my regular thing. No ethics session to give up there. We're going to talk about a few developments this week that took place in tax. A lot went on, funnily enough, in the Second Circuit Court of Appeals, but we'll talk a little bit about that. First, we're going to talk about the Denham case that involves the self-employment tax and the issue involving the functional analysis test for limited partners. Basically, the taxpayer in that case has now filed their brief with the First Circuit Court of Appeals outlining their position about why they believe the IRS is wrong and the tax court was wrong in holding that we need to use a functional analysis test for what are state law limited partners. We'll discuss the Denham's position. Remember that this is one we've already had the arguments presented in the Serious Solutions case in the Fifth Circuit, but we are still awaiting that opinion. So this is another case in a separate circuit. So it's going to be interesting to follow both of those. Second, we're going to talk about a review of PICCIRC. I guess that's how we'll do this. PICCIRC. It's all caps, so I assume that stands for something. LLC versus Commissioner. This is going to talk about a disguised sale and a partnership. This was an arranged tax shelter, basically a transaction that was meant to be a basis shifting transaction. We'll talk about how that didn't go so well for the taxpayer when they went up to the Court of Appeals. We're also going to take a look at a decision we've gotten, probably final at this point. I don't know if the states are going to keep pushing as hard. But this is the old Tax Cuts and Jobs Act. This is the case that was now before the Second Circuit, where the state of New Jersey and certain New York, I believe, was involved in this too, along with Scarsdale, looked to overturn the IRS charitable contribution SALT workaround regulations. Basically, we'll talk about how that fell apart at the Second Circuit. Whether they are going to try to get the U.S. Supreme Court to hear this, I don't know. My guess is there's not a huge chance the Supreme Court would rule in their favor. So I think this is the end of the road, but we'll see how they go forward. Also, the Second Circuit Court of Appeals has now become the Second Circuit, not just in name, but in the second one to rule that there is the right to go ahead and, the tax court 90-day rule for a deficiency petition is subject to equitable tolling. So we'll talk a little bit about their ruling there. Now, I should point out, the first taxpayer to win on equitable tolling, still, when they got the right to go for it, it didn't work out once they went back to the court to get it, and that may very well happen here too. But at least the option for equitable tolling appears to be opening up. It'll be interesting to see what the tax court does, especially if the next case coming up before another circuit also goes against them. There is a history of kind of a 3 strikes and you're out view of the tax court. If they lose in 3 straight circuits on an issue with no wins, they have a tendency to maybe review it without waiting for every circuit to rule against them. So we'll see how it goes. And finally, released right at the end of the week, there is a clean energy credit termination rules. IRS Notice 2025-42 on beginning of construction. And this is an implementation rule for the One Big Beautiful Bill Act. So we'll talk a little bit about what that is, how it works, and how it's going to go, how it works going forward. But let's go to the Denham case here, right? Denham is going to outline what it considers to be the significant flaws of the tax court's use of the functional analysis test for limited partners in their filing with the First Circuit Court of Appeals. This particular case goes to the First Circuit. Now, take a look at this case. It is the opening brief citation here, Denham Capital Management LP. It is from the Court of Appeals, First Circuit, was filed on August the 8th, 2025. Now, Denham Capital is, as I said, challenging the tax court decision and application of a functional analysis test to define limited partner under federal law for self-employment tax purposes. And key to this is What exactly is the proper interpretation and application of the exception for limited partners under the Internal Revenue Code section 1402A13, related to limited partner and self-employment tax, as well as under the Social Security Code at Title 42 United States Code section 411A12. Now, that exception generally excludes limited partners' distributor's share of income or loss from net earnings from self-employment, except for guaranteed payments for services. So that's the basic structure. And Denham contends the tax court erred by distorting the statutory meaning of limited partner and by addressing this partner-level determination in a TEFRA proceeding. Now, we're less interested in the second part of this because, again, we're no longer under TEFRA for new filings. But obviously, Denham will take a win either way. But for practical purposes, for those of us looking forward, we're more interested in them winning on the first part rather than the second part. We'll phrase it that way. So let's talk about what is a limited partner. And this is their primary argument. They're saying, look, you don't need to go back and figure out what it is. They said limited partner had a well-established legal meaning for a long time. It is a partner whose liability for partnership obligation is limited to their investment. That's their argument. Now, their supporting evidence says, look, this is the customary legal meaning that the IRS had been agreeing with for decades. General principles of statutory construction say that with legal terms generally presume their customary meaning, that we should do that. And historical understanding and the essential features of a limited partnership per the Uniform Limited Partnership Act suggests that, that's basically what it is. It is a limited partner is something defined under state law. The limited partners are limited to their investment. And that's really the key issue here. And legal dictionaries like Black's Law Dictionary also, reference primarily a limited partner has limited liability, that was the key factor for being a limited partner. They also noted that there is agency interpretations supports this position. The Social Security Administration, under the Social Security Act, has consistently defined limited partner by limited financial liabilities ever since 1978. Right? That's when we got the exclusion. That was when this part all got added to 1402. And Social Security has always said, yep, that's limited financial liability is the key issue. And even the IRS, the partnership return instructions have consistently stated a limited partner share is generally excluded from self-employment income. So Denham says, those indicate that we had a solid definition going in. They also noted congressional action and a failed regulatory attempt. In 1997, Treasury attempted to redefine limited partner using this very functional approach. Now, Congress enacted a law that prevented new regulations until July 1998. They expressed concern over the IRS exceeding its authority by doing so. Now, I do have to comment here on one issue. They did that, of course, in theory, because that would give Congress time to directly address this and stop the service from issuing such regs. They could have passed a law simply saying, IRS, you cannot issue any such regs. What is interesting is they didn't. And that's probably going to be something the service will point out. Is probably something, even if the service didn't point it out, the panel's going to question them about. Why didn't they just bar them? They have the power to do so. Why didn't they just say flat out, limited partner is limited partner under state law, and bar the IRS from issuing regulations to the contrary? Well, I've always said it's called AARP. You do not threaten the financial stability of Social Security if you wish to stay in office, and Congress critters like to stay in office. So while raising the tax was a bad thing, where you're going to include people and have them pay the tax that would otherwise have to pay it, that got their attention. When they later figured out that if they did open these floodgates, that there could be AARP consequences, well, Congress, as normal, chickened out. That's what Congress is very good at. But Denham also notes, though, that the IRS in draft 2020 instructions did tried to put functional analysis language in the draft instructions, but they never actually made it into the final version. So the IRS pulled away from the functional analysis. So they're saying, look, we've got this long history that we should be able to rely upon of the fact that a state law limited partner definition is what matters for 1402A13. However, if you remember the cases where things went off the rails, the tax court focused on the fact that 1402A13 does not simply say a limited partner, right? That a limited partner, basically the pass-through income of a limited partner will not be subject to self-employment tax except to the extent, that they have guaranteed payments for services actually rendered. Rather, it has this interesting phrase, as such. A limited partner, as such, is subject to this rule. So the problem is, and we discussed this when we discussed these cases, one of the key rules of statutory interpretation is you usually have it wrong if that phrase could be pulled from if that phrase could just be pulled from the statute in whole and nothing would change. That would be the problem. So the tax court says you've got to define as such. That is the hook the tax court used, and in reported cases now, so basically it is the tax court's position, that as such is what brings in the functional analysis. They were saying they weren't referring to state law limited partners, basically in giving state law carte blanche. Rather, they were saying they're referring to a class of partners who acted like limited partners as they were defined in 1978. So understand the issue here. So one thing Denham's got to do is come up with why in the world is as such in the statute. Now, I'll be frank. I happen to believe it's just somebody got carried away and liked adding words. But yeah, and it could be that simple. But nevertheless, as such was added in 1978. And so we have to understand that, that the tax court in Soroban and then applied in Denham used as such in the statute to impose a functional analysis test. That means functioning as a limited partner. That's the test. Now we got a problem. What does as such mean? And we saw this both in Soroban when they were arguing. You realize that especially with how the Supreme Court's drifted, and we're looking at these, canons of statutory interpretation as being the ultimate way to determine if a regulation is valid. And frankly, you could even read, the way I read Loper Bright is virtually, almost as if you don't need a regulation because there is the perfect interpretation out there. And, the best interpretation, and that's what you should follow. So Denham does need to do something with as such, and they realize that. They said as such refers to the antecedent limited partner, meaning as a limited partner. And they're saying that was meant to distinguish when a person holds multiple capacities. They're both a general and limited partner within the same partnership, excluding only the share received as a limited partner. And that is a very similar definition that Soroban argued. That, that was why as such was in there. Now, again, we're going to see how the panels react to that. Do they believe as such was there? Again, whenever you get into trying to parse the English language from a legal perspective, we can get some interesting quirks and interpretations. But I do understand that everybody now knows that we got to do something with that word. We got to do something with those two words. So we got to have a meaning for them. And they also said the passive investor test. They said that doesn't really make sense. The tax court test required a factual inquiry into whether a partner's relationship is more akin to those of passive investors or employees. That's fundamentally what they've substituted for, from a pure state law limited partner test to a passive investor test. And this is interesting because we do have case law back in, I think it was around 2000, but I cannot remember the name of the case right off. I do remember that Bill and Burgess Raby wrote an article on the case that I read years ago, where we had a general partnership with a partner who did nothing, right? And, that person tried to argue for 1402A13 based on, to be quite honest, what looks a lot like a functional test. And the court turned him down, right? Saying, sorry, you're not a limited partner. You decided to, The partnership didn't form as a limited partnership, so we're not giving this to you. Now, they weren't considering LLCs or LLPs at that point or anything else. But yeah, so they're just kind of saying, no, this really was, and theoretically all along should have been, the passive investor test, which would suggest that there's some case law back there that would be wrong, because if it meant you didn't have to be a limited partner, even though you had to function like one, that's a different world. Now, I'm going to add LLCs and all the variant LL everythings kind of fouled this up, because clearly there are a lot of people that aren't limited partners. If you literally strictly go state law limited partner, we got a problem. Our LLCs and LLPs are not that. And then the other way is, though you go this direction, then does that mean a general partnership? If you had a partner who just is doing nothing, and they may be liable, but they're not doing anything, do they get this benefit? There's a lot of problems trying to figure out how this test works. And yes, LLCs, LLPs, and all those things have created a bit of chaos in the area. And that chaos has never really been addressed, and that's why we have these cases. So let's go with Denham's arguments against doing that. Number one, Denham says statutory consistency. The guaranteed payout carve-out explicitly allows limited partners to provide services for self-employment income, contradicting the idea that they must be passive, right? So a limited partner, if we're just looking at what they do, the law suggests that you could have limited partner amounts, and you could have you'd have limited partner amounts that weren't subject to SC tax, and still the same partner could have guaranteed payments that were subject to it. The statute very clearly provides for that. They also said they want to contrast that with other provisions. And this is one where they are do something the courts like to do. They say Congress knows how to impose no services requirement. They said, take a look at the requirement for a retired partner not to be subject to SC tax. They have to perform no services. Also, farming syndicates and the passive activity rules. If you perform no services, right, and you're exempt from SC tax, right? But they did not use those tests for limited partners. And they point out, the retired partner exception predates 1402A13, and the farming syndicate, is afterwards. So Congress, both before and after this provision, knew how to write something that said you can't do anything. Why didn't they do that here? They also believe it is an unworkable and indeterminate test, multi-factor test, leading to a lack of tax certainty. We can't know if somebody is a limited partner or not because it's facts and circumstances. Now, I understand the concept, but I also understand we have a whole lot of that in the code, right? Facts and circumstances in general. And they also say they misplaced reliance on cases like Rankmeyer. Rankmeyer involved an LLP or an LLC, not a traditional state law limited partner, where all partners have limited liability and may have management powers. And again, now they're emphasizing distinctions there because, again, we're going back to that, because you kind of asked them to overturn Rankmeyer, which has been the law now, since, 2011? It's been quite a while that Rankmeyer has been the law. Are you really going to ask a court to overturn Rankmeyer? Because that, they got to say, no, Rankmeyer can stand. This is separate. So we are getting into that. And like I said, LLCs and LLPs and how this works is kind of a mess. And we do have a bit of a mess right now in how you line these things up. Okay. They said procedural challenges. They said on an independent basis for reversal. So this is going the other way. They said the tax court erred by determining net earnings for self-employment in a TEFRA partnership level proceeding. So what they're saying is, foot fault here, the IRS went down the TEFRA route. This really should be, imposed or tested at the individual level. For an item to be a partnership item under the TEFRA rules. Now remember, we're not really under TEFRA rules anymore. So any partnership returns you're filing today, this whole line of argument, interesting though it is, really only applies to partnership returns before the Bipartisan Budget Act rules took effect, which I believe was tax year 2018 is when you had to start using them. So, we're looking at returns before 2018. But for an item to be a partnership item under TEFRA, it must be required to be taken into account for the partnership's taxable year and more appropriately determined at the partnership level. Now, the interesting part about the BBA is it only covers Chapter 1 taxes. So apparently the concept of self-employment tax issues is separate from BBA exams, but TEFRA wasn't quite as clear. So they said, so there's the individual-centric, get that right, nature of net earnings for self-employment. That is computed by individuals, not partnerships, based on their individual income and taxable year, right? The relevant Treasury regulations do not list net earnings for self-employment as an item more appropriately determined at the partnership level. Net earnings for self-employment determinations are based on partner-specific facts and affect only that individual partner's self-employment, liability, and not basically partnership or other partners. Now, this is an interesting argument they have here, but what I find really interesting about it is this almost appears to me to be the backup argument in case, because they're saying, look, you're testing at the partner level. Now, if you're going to test, because you could argue that they're trying to get a test at the partnership level by looking at, whether the partner owning this, with the partner would know that's controlled by the partnership agreement and the state law. Is that partner a limited partner? But they're saying, but you're going to break out of that, then this shouldn't be a TEFRA item, which is how I would interpret this as backup number 2, which means if the court goes down this path, it may not be as good for future years. So we'll talk about, just kind of look at it that way. The tax court conclusion on the aggregate amount of net earnings self-employment appears to be stemmed from IRS forms and instructions, which are not binding for TEFRA purposes. And TEFRA was to allow partner-specific terminations like net earnings self-employment to be determined at the partnership level, would obliterate the wall, they claim, between partnership level and partner level proceedings, contrary to TEFRA's design. So I say, I'm reading this practically as the option B in case they lose option A, right? We're going to kind of open up the door. So we're going to go down that path. Again, want to watch this case. I am still watching for the decision to come in, from Serious Solutions and Sorabon's. We're waiting on Sorabon too. That's also finally got decided, but that actually wasn't decided fully until after Denham. So we probably will see Sorabon file their own, basically appeal based on this functional analysis test. So I do expect we will have 3 circuit courts of appeal that rule on this. The catch going to be to see, do they break from the IRS, or do they break from, I should say, the tax court, or do they start supporting the tax court? The Fifth Circuit is the first one up, and traditionally that's always been the one most likely to break for the taxpayer, by a pretty good, it does more often than the others. So that's the one I think a lot of people have interest in, seeing what Serious comes up with. But after Serious, then you start looking at this, which is a First Circuit. And I believe that Sorabon would be a Second or Third Circuit case. It's a little bit tougher to figure out where they're going to end up going, but that'll be part of it. Okay. Now let's go ahead and off to the Second Circuit Court of Appeals. We're going to talk about disguised sales and sham partnerships. This is a review of PICCIRC, PICCIRC, whatever you want to say that, LLC versus Commissioner. Okay. Now, this is a Court of Appeals, case number 23-1982. It affirmed the tax court memorandum decision 2024-50, basically, and this Second Circuit decision was released on August the 11th. Now, this is going to be a focus of the scrutiny of a structured distressed debt investment transaction. It involved partnership taxation and anti-abuse doctrine. The point of this is it was a marketed transaction. It was intended to take high basis, low value asset, transfer the basis on that asset to an investor, right, effectively. Compensate to a certain extent the party that brought the debt in, that they knew was not likely very good, and then trigger the actual recognition of the loss at the partnership level, allocating most of that loss to this investor. That's kind of what we want to accomplish here, okay? Now, the key players in this was BDO Seidman, LLP. They marketed the program. John D. Howard was the investor looking for the loss. And Gramercy Advisors, LLC was the party that implemented this transaction. Now, this involved tiered partnerships. There were 3 of them. XBOXT, Xboxed, Somebody likes gaming, I don't know. PIMLICO, Pimlico. Okay. And then PICCIRC, which was the one we're going to deal with here, right? Where distressed Brazilian trade receivables were contributed. Basically, trade receivables, from Brazil with a Brazilian debtor who not in great shape. We're going to put it this way. So at the end of the day, PICCIRC reported an ordinary loss of $22,718,351. Right? We're going to discover that, basically these things were overwhelmingly bad. But it was disallowed by the IRS, right? The tax court sustained the disallowance and imposed accuracy-related penalties, and the tax court will affirm that decision. So let's take a look at what happened. Now, the tax court said we're going to do the disguised sales rules of Section 707A2B and Treasury Regulation 1.707-3. And this looks at contributions and related distributions as a sale if the distribution serves as consideration for the property and would not have occurred but for the property transfer. What they're trying to say is this is not a partnership. This is a sale of the receivables to the investor. And the problem is it's a sale of the receivable. If I buy receivables that have a face amount of, over $22 million from you, from another party, and I pay $300,000, my basis is $300,000, right? The party I bought them from would pick up the tax loss, and it would be, under U.S. tax law, I would say, would pick up the tax loss. Well, and remember, the other party here is Brazilian, as I recall. So yeah, it's going to be a little, in essence, they probably aren't disadvantaged by this if it worked under U.S. law. So what happens in this case is, there is a 2-year presumption. A transfer between a partnership and a partner occurring within a 2-year period is presumed to be a disguised sale. This is under Section 707A2B. It's, if within 2 years you have this transfer, that is presumed to be a disguised sale. It's presumed you sold it. It's not a partnership, because what they're going to try to argue is there's a contribution of assets to the partnership. And then there is a later, and let's say assets and the partner that's coming in, the one that wanted the loss, contributed cash. And we're saying, well, what that was forming it. Then a little while later, that cash, or at least most of that cash, rolls out to the partner that gave the asset to the partnership. And structurally, things work in that scenario so that the loss, basically gets transferred over. The basis gets transferred over, so the basis stays the same. That's what they're trying to accomplish. This rule says even if you can do that under the tax law, we're not going to go through the theories about why they thought that worked otherwise, but even if that's valid otherwise, we're going to, under disguised sales rule, say, we're going to restructure that. We're going to take that as a, purchase of the receivables directly by the investor, which would be a bad result in this case because, the investor paid close to face value after paying the fee to those marketing the arrangement. So basically, that doesn't look great. So here's what happened. Santa Barbara was the party that was holding these not very collectible receivables. They contributed those receivables to Xbox on August of 2002. Now, Mr. Howard acquired an 89.1% interest in Pimlico from Xbox for $300,164 on December 11th. So August, essentially receivables go into Xbox. In December, Mr. Howard got an 89.10% interest in Pimlico from Xbox, who was the other partner, going to be another partner in Pimlico. And Santa Barbara requested a withdrawal of $300,164, the exact amount that Mr. Howard had put into Pimlico, from Xbox on December 16, 2002, which was paid from funds, that were identical to Mr. Howard's payment. Now, remember, we had multiple partnerships in here, so it wasn't that Xbox, Mr. Howard didn't essentially, and this is part of the structure, which helps confuse matters, He didn't actually give $300,000 to Xbox, who then transferred that to Pimlico, or I should say to Santa Barbara. Rather, he gave, he gave $300,000, right? He may have given it to Xbox, but it was for shares of interest in another partnership. And then we also had PICCIRC, which got in the structure. It's I'm not going to go through the whole structure, but it was there, and all of these tiers are meant to at least help argue that it wasn't all coming from the same partnership, right? But bottom line, if we just treat all of that as a black box, Santa Barbara put receivables worth about 300 grand, but with a face value of well over 22 million into the black box. Mr. Howard put $300,164 in the black box. Santa Barbara got a check for $300,164 from the black box, right? And eventually, Mr. Howard would, when the loss on the receivables was triggered, would pick up that huge basis shift loss. Now, the court said these facts were not coincidences, right? The payment to Santa Barbara was sourced directly to Mr. Howard's acquisition proceeds. And I don't care if you put a few partnerships in the middle there, right? Essentially, this whole structure collapses. And you look at, like a black box, what went in, what went out. These are all related parties. This is not a bunch of independent parties with independent interests coming into this, financial interests. It was a preconceived steps to shift the basis to Mr. Howard so he could claim this really big loss because he had some really big income. We'll presume. Pimlico failed to rebut the presumption that this was a disguised sale. And like I said, if it's a disguised sale, things aren't going to go well from this point. They also looked at the partnership validity, said that's an independent reason this falls apart. A partnership must show parties intend to join a trade or business and share in profits or losses. This is called the Tower-Culberson test from historical case law. The court noted that the check-the-box regulations for LLCs don't automatically grant code benefits without a legitimate business purpose. So that's part of the argument here is merely wrapping an LLC, because what's going to happen is, they're going to try to say that, that may be true. This wouldn't be a partnership if it was just the parties getting together. But because an LLC and check the box, says a disregard, this type of entity would be considered to be a partnership by default, more than one owner. Hey, we're not really subject to that test. We have to be a partnership. And the court rejected that theory, right? They said no. They said there is absolutely no evidence that Santa Barbara and Gramercy Advisors, or PICCIRC, Pimlico, and Tall Ships, another party, engaged in a common enterprise with a community of interest in profits and losses. Tall Ships was another thing that got in here as a partner. In theory, they said no, there wasn't. There was, one guy looking for losses, one party looking to, make the best really bad situation with the receivables, and with basically having receivables from a company about to go totally bankrupt that'll be worthless. Everybody's trying to make the best situation, and the promoters in the middle, just taking a cut for setting this up, right? They said also the partnership anti-abuse rules under regulation Treasury Reg 1.701-2. They provide broad authority for the IRS disregard partnerships or principal purpose is to produce a tax consequence that is inconsistent with subchapter K's intent. This is interesting because I don't see that one raised too often, but the Second Circuit said, yeah, that also would kill it. In essence, this smells. And we're going to go ahead and we're going to accept that this smells, right? And say, hey, that also kills it. So dead, this thing doesn't work, right? The relevant factors as to why we would disregard it. The aggregate federal tax liability for the partners is substantially less than if assets were owned directly by the partners. Saying, so the partnership had to exist. Without the partnership, the tax treatment would be just wildly different, but not the economic results, right? The aggregate tax liability is substantially left if purportedly separate transactions were integrated, if we respect it. Like I said, we're looking at the form, but economically, the substance of this was, guy holding bad receivables, gets paid probably a little better than the value, right? Guy that needs big loss gets all this basis, and while he put 300 grand in and also likely paid the other parties, the tax benefits of this thing are much larger, and, the advisors get their fees. I mean, great. And they said it's necessary the partners have nominal interest, partners that are necessary. Because remember, we need somebody besides him in here. So we need partners. We said, look, their interests are very small. He had by far the largest. And under the terms of the partnership, every other party was protected from loss. So the only party, that had anything at risk here was him. Yeah, they're saying this wasn't a partnership. This is a bunch of paperwork meant to look like a partnership. Therefore, the Second Circuit concluded, the partnership should be disregarded for violating the anti-abuse rules and were shams. Now, the Second Circuit affirmed that. They said, yep, got it right. The tax court sustained accuracy-related penalties under 6662, and most importantly, a 40% gross valuation misstatement penalty. That means, the investor didn't just, I tried to claim a tax deduction, so I tried to get a benefit of, let's say, 30% of that, probably 37. Well, actually, it goes back earlier, so 2002. Yeah, it would have been 37. So, he got 37%. So, I mean, it'd be a pretty good chunk of 22 million. We're talking around 10 million or so. It's not just that, oh, shucks, I got to pay the 10 million I would have paid anyway. He also now gets a 40% additional penalty on top of that. So let's say he did save 10 million. He's got to pay back 14 million plus interest. Yeah, that's bad. And the 40% gross valuation misstatement penalty, it does not have a reasonable cause exception. So yeah, it's always bad there. The basis discrepancy, because PICCIRC reported basis of $23,075,495. That greatly exceeded 400% of the correct basis, which was at most $300,164 under the disguised sale analysis. Therefore, this was a tax benefit received from a gross misvaluation, and the court looked at it that way, and bingo, the 40% penalty applies, which is nasty. Right? Very, very nasty penalty, especially because there's really no good way to get rid of it. So, big problem. Now, the Second Circuit affirmed this, right? Second Circuit concurred the presumption of disguised sale was applicable. Pimlico had failed to rebut it. It explicitly noted these actions had the effect of engineering a tax windfall for Mr. Howard by shifting the tax laws. Gang, sham transaction is what they're saying. It was a preconceived step. The circumstances surrounding Santa Barbara's partial redemption were a preconceived step to shift ownership benefits of the tax loss to Mr. Howard. This was all put together from the start. It was all done simply to get a $20+ million loss to Mr. Howard from his $300,000 investment. And again, his tax benefits be way more than what he invested, so it was considered there. Now, practical advice. There's the old line that if something sounds too good to be true, it probably is. Now, we know in tax law, that's not entirely true. There are some things that sound too good to be true that actually work. But the problem is that's only when there's very, very, very clear guidance in the code, right? You have to realize if you have a transaction that you see is trying to shift basis or losses and using complex tiered partnership structures, expect that to have significant scrutiny by the IRS, especially if distributions are funded by the new partner contribution rather than entrepreneurial risk. Entrepreneurial risk means it actually operates and does something, and everybody coming in has a risk, if things totally fall apart, of losing everything they put in. The party contributing receivables here, they were going to get paid for those receivables, which, like I said, probably was at a premium. So yeah, they don't have risk. Generally it's structured so nobody else does. The theoretical other partners have no or very limited risk. And it's not doing something and generating the money to make that distribution. That was the problem. Also, be very leery of the 2-year presumption. This is a huge hurdle. The timing and matching of cash flows are critical indicators of the prearranged sale. Right. My catch is always, take a look at the black box view of it first. What's going in, what's coming out? What most times people promoting shelters try to do, and I'm not saying it was done in this case, these are big enough numbers. I'm going to presume he had other advisors, hopefully seriously looking at this, but we don't know what happened or who did it. But it's there. But especially for most of us, we'd be presented with a plan, and usually what the promoter tries to do is, with various legal opinions and other documents, just confuse the issue and realize, try to play on your insecurity. That, you don't want to say, I don't know, but I don't know is a perfectly good answer. But what's not a good answer is going along with the other party just because, they say, oh, we got a legal opinion here from this big law firm. Gang, under the Code of Professional Ethics, those who are CPAs, you cannot subordinate your judgment to anybody. I don't care how big the law firm is, right? On a matter that you have professional expertise, you're holding yourself as a tax expert. You have professional expertise in tax. If you are not capable of analyzing it, then you need to say, I'm not capable, and you need to, send it out. Get the information so you can understand whether, because there's just a problem here with you signing a return that contains this thing. You have to worry about that to some extent. Okay, be aware of that, right? What's going on. And the check the box election. While LLCs can be classified as partnerships, this does not automatically validate them for tax purposes. A bona fide partnership must still satisfy the Tower-Culberson test of intent to conduct a business and share profits and losses. So that's key here. This is not bona fide. And we also have the broad authority of the anti-abuse rules that allows the IRS to reclassify. Now, my gut is that I don't recall very often seeing the IRS win on that alone. Usually it's more like this where it just gets tossed in at the end. So, but again, it's there. And don't forget, the penalties are huge. If the promoter is wrong, if that legal opinion, which by the way, you probably didn't read, you just saw it was like a 300-page opinion, and that is meant to intimidate you to just accept it, because analyzing 300-page opinion is going to take a long time. Your client's going to want to know why they should pay you because they got this nice big law firm. I mean, you're this, you're the CPA or EA, sitting here in small town America, and they've got a law firm on Wall Street who has an office on Wall Street and offices all around the country. Had one of their partners sign this thing. Who are you to challenge it? Well, unfortunately, you're the tax advisor, and it is your job to challenge it. I did like a line an attorney told me a number of years ago about these sort of package transactions. His theory was easy, and he told clients, the thicker that legal opinion is, the more likely it doesn't work. Now, you can pay me to go through that, but I will tell you right now, I've never gone through one of those in detail where I didn't conclude it was a bunch of garbage that had mainly things to protect the party writing the opinion and was really hope that nobody ever read it. Now, I can do that. It's going to be costly, and you're going to pay every cent of it up front because this is going to be retainer time, and I don't finish. When I've basically used up your retainer, you need to give me more. I'm not giving you the final answer until I get all through this thing. But I would say, to be honest, the smartest thing you probably can do right now is just skip it. But if you want to, pay me. If you really think it works, pay me. But don't be surprised when I come back with tons of flaws. Again, as he said, these are opinions meant to intimidate, not opinions meant to actually stand up. Clearly, nothing stood up here, right? It eventually fell apart. Okay, next up, again with the Second Circuit. Now we're going to go the states in the Northeast trying to get the IRS for the other SALT workaround. Now, we all know the SALT workaround that everybody really went with was the pass-through entity tax. However, the PTET only works if you have a pass-through business to go through, right? If you are just let's say somebody who, let's say, is an executive with a Fortune 500 company, you're getting a 7-figure or 8-figure earnings for the year. But you don't have a pass-through, you don't have anything invested in pass-throughs. you're still getting nailed. And you can be way lower than that and still get nailed by the SALT cap, especially when it's at 10 grand. So the state income tax credits, the state tax credit rules, idea was a way to get around this in a way to get around the SALT cap that had been recognized by the IRS in Chief Counsel advices issued in 2010, one from 2010, that basically validated a program that is one that operates here in Arizona and was virtually identical to these programs, except the goal was not a SALT workaround. It was a private school tuition organization program. And the question there. So let's talk a little bit about what the case was and what happened. This case is New Jersey versus Besant. By the way, the current Treasury Secretary just gets swapped in there. So, that versus has changed multiple times as the case has moved around from time to time. Current Treasury Secretary is now, who would be in the case listed today when it came out. We also had the Village of Scarsdale, New York versus IRS. And that was technically really the case that granted standing. So we will go to that. This is Second Circuit. It was dockets number 241499CVL, which was for the New Jersey case, and 241503-CVCON, which was for the Scarsdale case. This opinion was issued by the Second Circuit on August the 13th. Now, background, as we all know, in 2017, the Tax Cuts and Jobs Act capped the federal deduction for state and local taxes at $10,000 for individuals. What some states did, they took a look at the programs like Arizona's private school tuition organization program. That program that had been operating for a long time. I think it started in the latter part of the first decade of the 2000s, maybe earlier than that. And there, what was happening was you made a charitable contribution to a organization that gave scholarships to students, needy students for various private schools, quote, needy. Some questions all rose over time as how needy some of these were, but okay. But it gave scholarships to these kids. And what you got was a dollar for dollar credit up to the limits under the law. So if I made a $1,000 contribution to this organization, that was tuition organization, I had my Arizona income taxes reduced by $1,000. And in 2010, the IRS and Chief Counsel advice ruled that that was not a quid pro quo. That is, you didn't have to recognize the value of the asset received, your ability to knock your Arizona taxes down by $10,000. So you could still claim that as a charitable contribution. It was not considered a payment of Arizona taxes. Now, Arizona was probably by far the most aggressive with 100%. Other states would do similar things, but not give you 100% credit. Okay. But with that background, certain New York, New Jersey, Connecticut, various places looked up and said, hey, why don't we do that now? Except now the donations will go to pay for, certain things that are, government-funded things. And by the way, people in Arizona started screaming, well, that's not right. That's not. I said, I did have to point out to them, look, we have another credit, like the private school credit, which is for basically for a special state-run assistance program for military families. And I'm saying, in that case, you're making your contribution to the state of Arizona. So it's not as if we didn't do it that way too. The tuition organizations were different than that, but the military credit was basically going to a fund that was administered by the state of Arizona. It was a state government fund. So the fact that they were having it go to a medical fund for the state or to an education fund for the state, that to me, I said that's not what's going to kill it. That's because remember, what got very concerned in Arizona was they didn't want to lose their charitable contribution either. By the way, they did as we get to this, but we'll go forward. So anyway, New York, New Jersey, Connecticut, and localities like the Village of Scarsdale enacted legislation that established state-administered charitable funds for which you would get a credit against your state taxes. And in these cases, it was not 100%, but it was definitely more than high enough that you were ahead of the game by making this contribution. So state won, you won, IRS lost. That was how this would work. Hey, that was what was, arguably that was going on in Arizona, except the state wasn't really winning because it was 100% credit. But otherwise, you won, the school won, and IRS lost. That was how those credits worked. Okay. So what happened here was the residents of those locations, just like here in Arizona, would make voluntary contributions to the funds and receive a sizable state local tax credits. Often 85 to 95%. We didn't mess around with those little numbers. We go full bore in Arizona. We did 100% of the contribution. Now, the intent was to allow individuals to deduct the full contribution from federal taxable income under IRC Section 170, thereby circumventing the $10,000 SALT cap. Okay, no question. And by the way, that was immediately brought up in Arizona in late 2017 that, hey, wait, if you make this big contribution to, 2017, 2018, if you make this big contribution to these school funds, you could get them. Now, obviously, you were limited because Arizona didn't allow unlimited contribution. However, they did allow unlimited contributions for S corporations or corporations if they signed up. So amazingly, but you had to get approved. There was a cap on those, but it could be up to whatever until they ran out. So you could contribute as much as you wanted if you got there in time. And in Arizona, you had to get your application in. You could do it on the first day of the fiscal year, which was July 1st. And that year, Arizona's S Corporation Fund, the available funds were gone, what was they say, within 30 seconds after they began, opened up the electronic acceptance of them. Yeah, all the funds were gone virtually instantly. By the way, a year later, when it became clear that that probably didn't work except for very limited cases, yes, suddenly there was no demand to put the money in. And Scarsdale will note the same thing here. The demand, these contributions totally dried up once the IRS issued the regs that sought to shut this down. So what the IRS and Treasurer promulgated a final rule, final regs, requiring a taxpayer claiming a charitable deduction to reduce it by the amount of any state or local tax credit that the taxpayer receives or expects to receive, with an exception if the credit was 15% or less. Now, there was a way around this, exists under the regs, if you could show that this was not a charitable contribution, but it went to a charity, it was meant to be, a business expense. If you could show that, then you could claim it's a business expense, and there was no offset quid pro quo rule because it wasn't a charitable contribution. Interesting enough, that worked. It goes back to, I believe it was the Marquette case, if I remember right. I forget the name. May not be, Marquette was university. It's like that name, but it was a travel agent who primarily sold travel to exempt organizations. She would be their travel agent. And when a new exempt org popped up, a charity popped up, she would make contributions to the charity initially. If they booked with her, she would, kind of figure out how much she'd contribute based on how much they booked with her. If the charity didn't book with her, she stopped contributing. It was all keyed on that to keep the, she needed to be a contributor so they'd use her. So she did that. She won. She won her case. And this is back in the 70s, I think. So basically she got deducted above the line. But there are very few cases where that's true. Yes, you might be giving to this private school fund, giving all this money. But guys, you are basically a wholesalers of cardboard boxes. Your customers are like supermarkets. They don't particularly care if you gave that organization. That's not going to move a single box one way or the other. Now, it'd be a little different if, like her, your job was somehow doing some support work for these organizations, then maybe it is marketing, right? That'd be the key. So that was how that one got done. So there is that exception. I keep that in mind. Doesn't really matter, though, unless you're in a state like Arizona, because these programs pretty much disappeared as we did this. Now, the question for this lawsuit, because these, basically the 3 states and the city of Scarsdale sued right against us. So the first question was, could the state of New York and Scarsdale, who implemented these first, they said they possess standing to sue. They presented evidence of actual and imminent declines in program-related revenues directly resulting from the final reg. Arizona could point them out to a net corporation. In essence, as soon as the word got out the IRS was not going to allow a deduction, people stopped doing these programs entirely, right? They just stopped doing them. So they're saying, look, this is actual industry, right? Injury. Because, the IRS tried to argue, they didn't pay any taxes to the feds, so they aren't directly impacted by this. They have no standing. The court said, yeah, they have standing. They said there's injury. In essence, they can show they've been injured by this reg. They can trace the injury to the reg, and the court they said that's obvious. And could the court provide them with some sort of relief? Yes. If the court struck down the reg, it's fairly clear the contributions would go back up again. So yeah, we can do all of that. They have standing based on all three of those. So the IRS next argued for the Anti-Injunction Act. Generally, it says that you basically can't have a suit to restrain a tax assessment. This is found under the Internal Revenue Code, Section 7421A. Now, the court said the Anti-Injunction Act, while it does generally bar that, did not bar this case because there is an exception called the Regan exception. That exception applies when Congress has not provided the plaintiff, New York or Scarsdale, with an alternative legal way to challenge validity of the tax. Because as the IRS was arguing under their Article 3 standing, they had no direct tax liability in the final rule. They could not pursue a refund suit because they're saying, well, they should pay the tax suit for a refund. That's normally what you have to do. But they're saying, they're without any form which to assert their liability. Now, they said it did not apply solely to constitutional issues. The IRS say, well, Reagan was a constitutional issue, so it applies solely there. And they also said no, because the IRS tried to say, well, no, they got to go find a taxpayer who was, who basically contributed to the fund, had their loss disallowed, or had their loss disallowed, paid the tax, and now suing for a refund. Now, by the way, the weird part about doing that is, as was discovered a couple of years ago in a case in Tennessee, where certain people with crypto were trying to force a test case through, what the IRS can easily do in that case is just simply refund the person that, that was going to file suit. And, we were just going to play whack-a-mole for a while, trying to get the suit. So the court said, no, they do not have to jump through that hoop. They are damaged. They are damaged by this nature. They do not have to go find a citizen to sue you. They can sue on their own. So we're good. They can go ahead. That's not a problem. Now, one interesting thing about this case, at the district court level, remember, this goes all the way back to 2018, right? So this case was decided before the Supreme Court issued the Loper-Bright Enterprises decision. Remember, Loper-Bright said courts can no longer use Chevron deference as a reason to sustain a regulation. They have to go through the whole bit about deciding, is it the best interpretation of the law using standard tools of statutory interpretation, right? And they said, well, because the district court had sustained it, because they said it was within Chevron deference. And, IRS says now, interestingly enough, basically, I should say the state saying, nope, no deference, so therefore we win. Court said it doesn't work that way, right? Basically, even though Loper-Bright was there, and even though IRS can't win on Loper-Bright, that doesn't mean the court came to the wrong conclusion. And the Supreme Court even said that, right? So the court said, we're going to examine this now. We're not going to just say you win because the court said Loper-Bright. That's not good enough. So we're going to take a look at IRC Section 170, the charitable contribution definition. And a charitable contribution is a contribution or gift for exclusively public purposes. There is, as been found by the courts over the years, an implicit quid pro quo principle. Because remember, it's got to be exclusively public purposes. Decisional law dictates that a payment generally cannot constitute a charitable contribution if the contributor expects a substantial benefit in return. It is an objective test. It focuses on external features. It's not really a charitable contribution if I give $5,000, to an organization and they turn around and give me an asset worth $5,000. That's a purchase, guys. That's not a charitable contribution. In this case, the court determined that a tax credit offsetting state and local tax liabilities was an identifiable benefit because it reduced the amount owed. It's got a tangible benefit. The fact that the contributions all but dried up after the final regs were issued showed that credit was the benefit people were expecting, and if they didn't get it, they wouldn't make the contribution. Right? So basically, sorry guys, you have to reduce the contribution by the benefit received, which in these cases was 85 to 95% of what you put in. So that just means that, you've only going to get a contribution for 5% or 10%, 15 to 5%, or in Arizona, 0% of the, in Arizona, the private school tuition organization setups, right, that we have here. Now, but then the state said, no, because people make a charitable contribution, they always get a reduction in federal taxes, in state taxes. So, you ignore tax reductions, right? Because we ignore them. The court said no. 170 explicitly permits the federal tax deductions. Congress did not consider the deduction itself to be a quid pro quo. In essence, it may arguably be one otherwise, but Congress blessed it in the code specifically. So that does not disqualify it. That benefit does not. But a tax credit that directly offsets a tax bill and provides a very specific and measurable benefit, unlike a deduction whose value varies, therefore a tax credit is a different beast. And even though the benefit of a tax deduction would not be considered a quid pro quo, a tax credit would, because Congress said nothing about tax credits in the structures. They also said, the state says, well, it has to be goods or services are what count for this purpose. And the principle says, no, the general quid pro quo principle, I'll get that right, didn't really care whether or not there was a substantial benefit received in goods or services. It's just, is there a benefit received? The fact that, a tax is neither a good nor a service, repayment of a tax, does not mean it's not a quid pro quo. So therefore, the court concluded that the final regulation, correctly interpreted Section 170 as applied to these programs. So even using Loper-Bright standard, this reg is valid. Okay. Finally, they said, the state said, well, a regulation can still be thrown out under the Administrative Procedures Act if it was an arbitrary and capricious standard review, right? The court found that the final rule was not arbitrary and capricious, noted the standard review is narrow and particularly deferential to the agency. We've already cleared Loper-Bright, which might even raise a question as to, does it matter if they won this one? But the court cleaned it up anyway. They said, look, the final rule's preamble adequately explained the state deductions raised different concerns, a lower risk of circumventing the SALT cap, administrative complexities than do deductions. So in essence, they addressed that issue that the states complained about. The IRS adequately considered that there was a disincentive to charitable giving, targeting specific programs, not general giving. It didn't say everybody had to reduce for every single little credit you might get. The 15% threshold was found reasonable as lines had to be drawn, and aiming to treat taxpayers' economic equivalent credits similarly, right? They said it was proper for the IRS to consider the revenue-raising objective of the SALT cap, when promulgating this rule. And the big one they tried to hook on was that 2010 Chief Counsel advice. Now, I remember talking with a CPA here in Phoenix back when TCA came out, or actually online on the Arizona Society's discussion board. And he noted, I agreed with him, that when that Chief Counsel advice came out in 2010, we both thought it was horribly flawed. But as he said, if they're saying we're not challenging the deduction, well, I'm going to take the deduction. Yep. And so we did. In Arizona, we all took that deduction. And fundamentally, it was based on the Chief Counsel advice, because a lot of us were uncomfortable before that advice. This looked like a quid pro quo to us. Okay. Now, the final rule did explicitly question the reasoning of that Chief Counsel advice. And it did explain its departure in light of the 2017 tax acts and the tax credit schemes. It tried to, it did say that might not have been reasoned right, but even if it was, that now, in essence, we now get a deduction where previously, it didn't matter because it would reduce your state income tax deduction but raise your charitable. And now it would, do neither. It would get a deduction, wouldn't exist otherwise entirely. Uh, the problem with that analysis was, as everybody here in Arizona knew, if you made it to the organizations that got the tax credits, that stuff was allowable as a deduction if you're subject to AMT, while Arizona taxes weren't. So there was a very good reason to do it basically back in 2010. And it did not mean that essentially there was no difference because of the AMT. There was a difference. Okay. So that's there. Oh, by the way, don't forget also, this law does allow us to go ahead and still claim the deduction as long as we have space under the SALT cap. Remember, that is part of the reg. Since the SALT cap's going up to $40,000 this year, those of you in Arizona, we now can, they're going to have a lot more clients who will be able to make charitable, who will be able to make contributions to these organizations and claim the deduction. Still doesn't make them as good as a PTET, but but this is an Arizona podcast, so we're not going to go into detail about why the pass entity tax is better than Arizona's credit for schools, but I'm just going to mention, remember that if you do have any of these credit types. Okay. So ultimately, the Second Circuit affirmed the judgment of the district court. The final rule correctly interprets Section 170, is not arbitrary capricious. So basically, I think this is the final nail in the coffin for state tax credits, being able to claim them, to have a state tax credit that, either overwhelmingly offsets your state tax with equivalent dollars, or does so, in a way that wipes out your entire amount that you gave there. So whatever you gave, you get that directly. Yeah, they're kind of dead. You might say, what about PTETs though? Don't they do much the same? Well, see, that's not a charitable contribution. And B, the IRS has never promulgated anything saying this is wrong. Do I think the IRS is correct in Notice 2020-75 about PTET taxation? No, I think that's just as flawed as the 2010 Chief Counsel advice. But do I use it? Yes. Because again, if the IRS is conceding it, we're allowed to use it. Hate to say, but that's the way it works. So yes, I do think the 2020-75, basically that notice is just as flawed as the Chief Counsel advice in 2010. But again, IRS hasn't come back and said, yeah, that's just wrong. They could, then we got a different problem. Second Circuit. This is now the Second Circuit taking on the same issue the Third Circuit had. If a taxpayer misses the 90-day deadline for filing a petition to the tax court on a deficiency notice, can they argue before the court for relief based on equitable grounds? Equitable tolling. Can they say, look, I was hospitalized, I was in a coma in the hospital, for basically the entire period I could have filed a petition. And so, and as soon as I was able, I filed a petition. Then we're going to see, can we claim that, or are we just out of luck unless Congress specifically wrote, if you're in the hospital, and in a coma for all those periods, then we're going to go ahead and let you file late. Okay. This is a case called Buller v. Commissioner. It was case number 24-1557, again from the Second Circuit. It was decided on August 14th. This is looking at the filing deadline under 6213A for petitions to the U.S. Tax Court for a notice of deficiency. Remember, notice of deficiency, otherwise known as a 90-day letter. You have 90 days from the issuance of that notice to challenge the notice in the tax court. If you do not do so within 90 days, you lose the ability to go to tax court, which means your only option is effectively, the only option you can force, I'll put it that way, is to pay the tax and then sue in district court or court of claims. Since most people don't want to do that, and it's generally also a lot more expensive to litigate there, plus paying the tax, losing the right to go to tax court is a major thing. Now, in this case, Mark Buller and Sarah Beatty, the petitioners, were challenging a deficiency, but their counsel, sounds like we could have a malpractice problem here, but we'll skip. somehow filed their tax court petitions 9 days after the 90-day deadline. This happens. People just miscalculate deadlines. They just get it wrong. And suddenly, it goes in. And by the way, 9 days after, that is, I have to go back. I can't recall the specifics of the case right now. But, that can easily happen because they didn't get it filed, let's say postmarked, or preferably by certified mail. Got certified mail receipt on the last day for filing. So now the date of filing becomes the date the tax court actually receives it, which, yes, could have been 9 days late. Doesn't mean that he actually filed it, he mailed it out 9 days late. It means that it arrived, finally got to the tax court 9 days after the end, because we are past the timely mailing statute, right? So we can't use it anymore. So on appeal, the taxpayer argued that IRC Section 6213 is not a jurisdictional rule, but a non-jurisdictional claim processing rule. The Supreme Court, will get to the case here in a second, but the Supreme Court has ruled generally that if, basically, if it's not a jurisdictional rule, if this is not the only way the court gets jurisdiction, if it makes it clear that this deadline is absolutely must be met for the court to have jurisdiction, if that's not clear, then we're going to interpret it as a claims processing rule, which doesn't mean you can ignore 90 days, with no negative impact. You're still likely going to have a problem, but you can at least ask for equitable tolling. Is there good cause? Can you show, basically cause why the 90-day deadline should be pushed back a reasonable period because of whatever was happening in your situation, etc. Now, what they asked for, a reversal of a dismissal and remand for the tax court to consider equitable tolling. The taxpayers will win on that here. The case will be sent back to the tax court. Doesn't mean they're not going to be found to not get equitable, they're not qualified for equitable relief because their situation doesn't qualify for it. In fact, I'll be blunt, most likely that's the result, just because of how difficult it is to get equitable tolling, but at least they have the right to argue for it. I'm going to assume that their counsel believes there is a case here for equitable tolling. We'll just see ultimately if that person's belief is found to be valid. If the service really thinks there's a risk here, though, I think there's also a chance that they just, settle. Now, interestingly enough, I also, though, would have thought, given they knew about the Third Circuit, the IRS could have prevented this from going to trial by essentially settling this case, settling their liability, under whatever method they want. And then, it wouldn't have come up. So the IRS felt like they could take this to court. Therefore, either they really thought the Second Circuit was going to side with them on this issue, in which case then IRS, you blew it, or, they thought it wasn't really that big a risk because they had a really solid case anyway that would kill the equitable relief, which happened earlier. In the Batchelor case, some recent Supreme Court decisions, Batchelor and Wilkins, urge greater precision using jurisdiction. Like true jurisdiction provisions cannot be waived and do not allow for equitable exceptions. Prior lack of jurisdiction rulings without explicit consideration are not precedential. So the courts are ordered to ignore prior ones. And they said, in order for a rule to be jurisdictional, Congress must plainly show such intent. A jurisdictional reading of a provision like in this case, in 6213A, needs to be clear it's jurisdictional, not just a plausible way to read it. So, the court looks at the language. And a provision speaks only to a claim's timeliness, not to a court's power. So the Second Circuit said it does resemble, as the Third Circuit found, a mundane statute of limitations language. The phrase "the taxpayer may petition" is permissive, does not speak in purely jurisdictional terms, where they could say the taxpayer must file their petition by, within the 90-day context. It didn't have a mandatory rule in there. It's a may. And also, the word jurisdiction does not appear in the sentence. 6213A sentence does not contain the word jurisdiction. Unlike other tax code provisions, which includes under, innocent spouse, 6013E1, and, 6213A lacks an explicit jurisdictional link. It doesn't condition jurisdiction on timely filing under its standard. And despite multiple times amending the various versions of this provision since 1924, Congress has never specified a jurisdictional bar for this deadline. So, based on that, looks like it's not jurisdictional. They rejected the IRS's arguments. The IRS pointed to a later sentence, a separate sentence, 6213A, granting the tax court no jurisdiction to enjoin unless a timely petition has been filed, does not make the entire section jurisdictional. The express statement of jurisdiction for injunctive relief only, right, if anything, highlights the lack of clarity in the main sentence. You wouldn't have to have said they have no jurisdiction to enjoin unless a timely petition has been filed if you just couldn't file any petition non-timely. Court said, actually, IRS, we think that helps the taxpayer's cause. The court reiterated that prior lower courts petitions with fleeting references to jurisdiction are insufficient. Because IRS said, well, look at all these prior opinions and prior appellate opinions. So we have to ignore them because they never talked about the jurisdictional label when it was not clear from the statute's text. And also they looked at harm to taxpayers. The IRS argued, well, a non-jurisdictional dismissal would lock in the deficiency amount was dismissed as a theoretical possibility. Seldom, if ever, are we going to have very, very few of these types of claims where, if there's a non-jurisdictional dismissal of the case, it's a lock-in. So what they said was, if they dismissed it for jurisdiction, there are some things available to the taxpayer that are not available if it's actually heard. This would be mainly in areas of, offers in compromise and various other structures where collection due process, where the taxpayer hadn't had a prior ability to dispute the deficiency. They said if they dismiss it, saying they have jurisdiction to hear it, that hurts the taxpayer. The court said, yeah, that's a theoretical possibility. We don't see it having much practical impact. And and they point out, a taxpayer, doesn't have to try to go for, this late filing after 90 days and argue for the whole issue of, having equitable relief available. They could just skip that filing, accept they were past 90 days, and still go the collection due process route. Okay. So Second Circuit definitively held that 6213A is a non-jurisdictional claims processing rule, right? So, like we said, the Supreme Court has established a presumption that non-jurisdictional limitations periods are presumptively subject to equitable tolling. The court found that rationale in Batchelor, which was with 6330D1, was subject to equitable tolling, right? Now, what I point out about that, when the Supreme Court in that case, while they found Batchelor had a right to have the court consider equitable tolling, when it went back for trial on the facts, the court found he didn't meet the standard, right? So yes, we considered it, and even if equitable tolling is available, you didn't clear the high bar. But the Second Circuit said the Batchelor decision applies 6213. That's exactly what the Third Circuit said. Same theory. Both statutes do not expressly prohibit equitable tolling, and their short time limit is directed at the taxpayer, not the court. So they went along with the Third Circuit, right? They could distinguish it from Brokamp. Unlike IRS Section 6511, which governs refunds claims and is not subject to equitable tolling, and that's important to remember. A refund claim is clearly not subject to equitable tolling, right? 6013A does not present as time limitations in a usually emphatic form, highly technical manner, or with numerous explicit exceptions unlike 6511. So if you miss and this is important for those ERC refund claims we discussed a few times, where the 2-year clock is beginning to run out, those don't have equitable tolling. You missed that date. I don't care. It's unfair because you didn't understand that appeals lost the right to actually issue a refund once the 2-year date passed. That's not going to help you get the case in district court. Also said there's limited impact. Equitable tolling for this is unlikely to appreciably add the uncertainty or encourage a wave of untimely filing, especially given a significantly smaller number of deficiency notices compared to tax refunds. And to be honest, I expect most appeals to equitable tolling are going to fail on the facts, right? It's not that, even when you get equitable tolling, it's not that easy to get it. I think that's the crucial issue, right? So critical takeaway, Again, now in another circuit, we have the Second and the Third Circuit. So especially those of you in the Tri-City areas, we pretty much picked up everything. Those of you in New York and its areas, or Tri-State areas to say there, guess what? Everywhere there now is covered by this, right? First and second. So essentially, those of you in the New York metro area, yeah, you got it. Plus those you just New Jersey, Pennsylvania have had it for a while. With the Third Circuit, this adds a second. So we get Connecticut, Vermont, right, in that one, along with New York. So we do that. An untimely petition may no longer automatically result in deficient. As said, it's now subject to consider equitable tolling. This is the Second Circuit Court to go against the tax court without, I believe, to date, any circuit doing a post-Batchelor decision that's gone along with the tax court. So again, we may see if, and I think there is that 3 strikes and you're out problem for the tax court. Are they going to give up now, or are they going to wait for a Third Circuit to come in? And if a Third Circuit comes in, do they go the 3 strikes and we're out? Implication for practitioners, especially we're talking about taxpayers who would file with the second, who would basically take their appeals from tax court to the Second or Third Circuit. Timely filing is still key. Gang, don't miss the 90-day deadline. That is crucial. This is a Hail Mary pass, if it's missed, right? So you do have to understand, though, under what cases would equitable tolling be possible, and probably in consultation with their counsel. Determine if, somebody comes into you, they have a notice of deficiency there, it's day 94. There's still a possibility. Don't tell them automatically they couldn't go to tax court. However, you may want to understand the principles, and you probably need to say, look, if you want to, we can check with counsel. We need to do so quickly because you now know you're late, and see if your facts would be one that they feel would get equitable tolling, and do they want to take it up? And again, that is a much higher mountain to climb if you're not in the Second or Third Circuit. In the Second or Third Circuit, you will get the equitable tolling hearing at the tax court level. Currently, if you're here with me in the Ninth Circuit, you're going to get the thing thrown out by the tax court. You got to go then to San Francisco before the Ninth Circuit, argue your case, get the Ninth Circuit to agree we're going to follow the Second and the Third, and then go back to tax court and try it, which is going to be way more expensive, right? You may need to argue for application in cases of late filing for extraordinary circumstances, and that's key. It has to be extraordinary circumstances. It can't be simply, I didn't realize, I was busy at work, etc. By the way, I was busy at work almost never works, because the court will point out if you had the ability to conduct business, then yeah, so probably better to point out what you couldn't get done at work because of the bad things that also kept you from filing this, right? They don't tend to go too far. They're busy. Judges are busy. They don't buy busy as an excuse, okay? So we get that. Now, again, this aligns the Second with the Third. So we now have 2 circuits. We are watching for the third one now, because again, I think once we get the third one, pressure grows dramatically on the tax court to reverse their position. But their national position is still, you got to file within 90 days. That was a report. They've issued reported decisions since that date, arguing they go within the 90 days. They believe it is jurisdictional. We just have to see. So again, somebody else has to take it up. So this means really, really pay attention. And especially if you're not in the Second or Third Circuit, keep your eye on your circuit, and probably at this point, even nationwide. Because again, if another circuit comes down, that means there's a decent chance that'll be there. Now, as I said, ultimately, you don't want to ever have to use equitable tolling. But if that tool is possible, it's important to know it's possible, because one thing you don't want to do is having dismissed the whole thing and then have, let's say 6 months later, the client go to an attorney for collection due process. They're going to try to do collection due process litigation and discover that, oh, no. In your circuit, we could have got equitable tolling, and it was never done because you as the CPA never told the client that was a possibility, or EA. So make sure you understand that, what's there. Okay, now this came out on Friday. IRS Notice 2025-42. It is clean energy credit termination rules for the impact on wind and solar facilities. These have been somewhat controversial. Reportedly, Lisa Murkowski is not happy with what's happening here, as are a few other senators who feel that they were lied to, shall we say. Well, that's the way. They won't quite phrase it that way, but that's kind of the feeling they're giving, the vibe they're getting, because they were told that these projects would be allowed to continue, and they wouldn't be cut off until next June, and everything would continue as is until then. But then to get the One Big Beautiful Bill Act through the House, they made, in essence, the administration made promises to certain Congress people to get them to vote for the bill, that they would essentially, basically make it very, very difficult to get projects going before next June. And it's not just this ruling, it's some other things going on. But anyway, this now has become a bit of a controversy. So we're going to see where things go. This is IRS Notice 2025-42. Was issued on August 15, 2025. By the way, having people believe that they were misled, Congressman, that always happens, especially when you got a bill like this. In essence, deals have to be cut. But pretty much, and I think any congressman or senator should know this, any deal that's not actually written into the bill in a way that they can't back out of, The problem that you have, though, if you're administration and you sometimes you have to do deals like that, is it means when you come back the next time, you're not getting that vote, let's say a Murkowski, unless you actually write it into the law with absolute prohibition of doing anything differently, that all of the guidance previously issued would remain as is, and that, and agencies would be directed to, expedite the processing of any licenses, approvals, whatever. Yeah, it's more complicated for the next bill. That's also, to be honest, totally why quite often administrations have trouble after their first year in office ever really getting that kind of legislative big victory again in the future. Because, in essence, they had to do things to get the first deal through that are now making people not trust them on the second. How the game's going these days is just got to be aware of that. Okay. So this notice is guidance on beginning of construction for wind and solar facilities, because under the credit termination provisions for sections 45Y and 48E of the Internal Revenue Code, tax credits and benefits for constructions of certain wind and solar facilities, they essentially need to start their construction by September 30 of 2026. And the key question becomes, what is beginning of construction? Now, this executive order is what got everything rolling, issued shortly after. Executive Order 14313, ending market distorting subsidies for unreliable and foreign controlled energy sources, and that really has to be read with an implied and. That order did tell agencies and the IRS to, make sure people couldn't get too easily into beginning construction. So the argument is that this notice and the executive order are to prevent circumvention and artificial manipulation of credit eligibility. Now, I will say probably certain senators would say, no, that's not right. No, it was because you had to buy votes, and that's what you did. Okay, yeah, but again, we're just going to worry about what it says, because our job is not so much to, like it or not, none of us referee the Senate or the House. So, like it or not, we're just going to move forward. Whatever the focus is, what exactly is the law if you have a client that's potentially impacted by this? So again, OB3. I'm thinking I'm not getting it because going with all the B's gets tough. Public Law 11921, right? Its official name. There was an act on July 4th, terminates the credits for 49Y Clean Electric Production Credit and 48E Clean Electric Investment Credit, right? The termination, in this case, are for wind and solar facilities placed in service after December 31st of 27, right? Did that. And it applies if construction facility begins after July 4th of 26. So the real question was, that's going to be a key date because a lot of these facilities are going to take a while to build. So, what's going to be the beginning of construction is 12 months after the enactment. Executive Order 14315 directed the Treasury to strictly enforce these termination provisions and issues guidance to prevent circumventions, including restricting broad safe harbors. Prior to this being issued last year, or let's say earlier, I forget when it was, but it was recently as part of the IRA guidance, the Inflation Reduction Act, there was a 5% safe harbor, right? If you had essentially incurred 5% of the costs, expected cost of construction, by the date the construction had to start. Now remember, this was looking way out in the future, right? There was a beginning of construction date, but it was way further out than this, right? That would be there. So this is at the end when, when the things start going away, and when I'm sure in theory the idea was, well, we'll go back and we're going to extend these provisions before we get to that date, so it would never matter. But anyways, they did that. That 5% safe harbor is no longer available for determining beginning constructions for these credits, except for low output solar facility, a special subcategory. That is going to be somewhat favored. So we'll get there. So the real question was, how do you determine the beginning of construction? And this is going to essentially take us down to the physical work test. Under the prior guidance, the physical work test was one test, but you could use the 5% test in appropriate time. So now the physical work test means construction begins when the physical work of a significant nature commences. The focus is on the nature of the work done, not the amount of work or its cost. So again, different from the 5% test. Qualifying work does include off-site manufacturer-specific components like inverters and transformers, and on-site work, but each subject to limitations, right? Work performed by others under a binding written contract entered into prior to the work taking place is taken into account, right? Exclusions are preliminary activities. You cannot count planning, financing, permits, studies, site clearing, and test drilling, and works on components already in existing inventory are not considered physical work of a significant nature. So if you're using off-the-shelf parts, the fact that you contracted to receive them, it doesn't matter if the vendor begins, making those parts, simply because they're inventory parts, right? They're going to make them eventually anyway for somebody, so you can't go back and identify the parts that specifically got shipped to your contract and say, well, they got started for July 4th of 26. Even if you had a contract, you're not going to be able to do that with them. You also must maintain a continuous progress of construction with continuing physical work of a significant nature for us to qualify under this test, to qualify under the beginning of construction test. You cannot start construction, but then kind of, stop and unreasonably just kind of do nothing, right? So you can't go out and just start a whole bunch of projects that maybe wouldn't take a super long period of time, but you can't get them all started, and going and finish them in a short period of time. Each one, you have to do them kind of staggered. Well, if that's the case, then yeah, when you stop working, that'll be a problem. Now, the continuity safe harbor satisfies facility is placed in service no more than 4 calendar years after the calendar year in which construction began. So bottom line, if you complete it within 4 years, then we're good after construction began. But if it takes more than 4 years, then we're going to look for breaks and may not allow you to get the credit because you won't be considered to have begun construction before the magic date. Now, there are some excusable disruptions that will not break continuity if there are delays truly beyond the taxpayer's control. Severe weather, natural disasters, delays in getting permits, interconnection issues, supply shortages, financing delays will not indicate failure to satisfy the continuity requirement outside the safe harbor. Right? The single project rule says multiple facilities operate as part of a single project. Common ownership, contiguous land, and shared interconnection can be treated as a single facility for determining beginning of construction. So in essence, if we have a number of facilities, but they are significantly related, they're a single project, we can start construction even though maybe one particular facility we haven't really done anything on as of July 4th of 26. Okay. So, how about a transfer of the facility? A fully or partially developed facility can be transferred without losing its physical work test qualification, and relocation of components by the same taxpayer is permitted. However, work performed by an unrelated transferor or transferred property does not count. So basically, an unrelated party can't take it over and still qualify for these benefits. And for retrofitted facilities, we're going to have an 80-20 rule. The physical work test applies only to work performed on new components, providing the value of the used components is not more than 20% of the total value. Now, we said there was an exception for low output solar facilities. Unlike wind and solar facilities, a low output solar facility may establish beginning construction using either the physical work test or a principle similar to the 5% safe harbor. So effectively, they have a different way to go through it. Now, an Apple facility is one with a maximum net output of not greater than 1.5 megawatts as measured in alternating current. The output measurement is based on the nameplate generating capacity. In multiple low output solar facilities have integrated components, same owner related, same tax be replaced in service, common interconnected. Their output is measured in the aggregate. Okay, so these small projects, right, they can meet the July 4th. They still got to meet the July 4th, 26 start a construction date. But they can meet that date, right, in essence, by using the 5% test, not having to show there was significant physical work. Okay, and that's going to be key. Now, the other key notice, this notice is effective for wind and solar facilities whose constructions did not begin prior to September 2nd. Now, that of 25, so you still got a little bit of time. If you can meet the 5% test effectively, right, basically by September 2nd, then you're fine of 25. Even if you don't meet the physical test by next July. That may get you a continuity problem, but so be it. But that's going to be the key. So the notice that you've been working on it for right now, if you can meet that 5% test by September 2nd, you can use the old notice, right? Notice 2022-61. If you don't meet it, then you got to go back to this notice. So this has been the current federal tax developments for August 18, 2025. As always, current federal tax developments are brought to you by your state society CPAs. You can email me questions, edzollers@currentfederaltaxdevelopments.com. If I have time, I'll try to get back to them. I also spend time on the Connect sites for the Arizona Society of CPAs, New Jersey Society of CPAs, the Idaho Society of CPAs, Minnesota Society of CPAs, and Washington. So you can take a look at me. If I see something there, I may reply. Otherwise, we will see you guys back here next week. We are now within 1 month of the first drop dead due date, that wonderful trifecta of September 15th, September 30th, October 15th, right? Partnerships and S corporations, gang, flow-throughs. Those flow-throughs come up real soon. We're within, you only got a few weeks to get those done. So you got a bunch of those ready to go. It's time to get moving on them. And again, we're just going to go through this, kind of bang, bang, bang. I have a few additional CPE courses to give, next week. But again, they're going to start pilfering. They're going to start disappearing to some extent because as we get to this time period, it gets tougher and tougher, to make those times work. So we'll take a look. We'll do that. Otherwise, we will see you back here next week for more current federal tax developments.